Good morning, everyone. Welcome to today's webinar presented by CBiz. We're going to get started, but I wanted to do just a couple of housekeeping items. If you have any questions, please make sure that you're using the Q&A function or the chat, and we will take those in and then ask them for you, or you're able to ask them yourselves. Couple of things for reminders. We do have some upcoming events, so please make sure you're checking our events page on the website. We have a virtual program on May 4th, May 18th, and June 10th is our first in-person program. So this is session 2 for CBiz, how to determine the worth of your business. I'm going to talk today about making sure that you guys are signing up for the next session on June 22nd. It is live on the website. We will send out reminders to everybody just so that they know to sign up for that. And then keep in mind that August 12th is also set. We're looking at possibly October and December for the remaining sessions. Today's speaker is going to be Howard Kaminsky. Howard's been in accounting for 41 years. I just met him the other day. He's a great guy, great speaker, so I'm really excited to hear everything that's going on. And then we also have, excuse me, Christopher Riley, who will also be speaking with us today. So the fun thing about this presentation is it's going to be a back and forth, almost live panel session with our two speakers. And from there, I'll hand it over to Howard.
All right, good morning. Thank you, Lacey. I was enjoying James Taylor music, so that was good morning. I'm Howard Kaminsky, and Lacey introduced myself and Chris Riley. We're going to be trading back and forth the discussion on business valuation over the next hour, so hopefully you won't get Zoom fatigue with our voices. Very quick, I just want to give you a little bit of history on Chris and myself, and then a little bit on CBiz, and then we'll go right into the topic. Between Chris and I, we have a little over 67 years of experience. Oh my gosh. We've prepared in the last 40 years, probably anywhere from 2,500 to 3,000 valuation reports. And we've prepared reports for all types of businesses. We've done retail businesses, distributions, service businesses like law firms, engineering, accounting, and we've done many manufacturing businesses over the years. Manufacturers of just about any product you can think of, it seems like we've had in our office and we've valued it. And different reports for different purposes, and that's really important. We'll talk about that a lot during this morning. So we've prepared valuation reports for gift and estate tax purposes. We've done reports for buy-sell agreements. We've done reports for clients who are purchasing businesses or selling their business. We've prepared reports for owner disputes, partner and shareholder disputes. And we've prepared reports for divorces. So depending on the purpose of the report, we may be more aggressive, we may be less aggressive in terms of valuation. Just a real quick commercial on my company, on CBiz. So CBiz it's a national firm. There are, I think, 90 offices around the country. We are obviously in the Minneapolis office, downtown Minneapolis, which hopefully the plywood's coming off the streets today. It was a little nervous this week, but things look pretty clean, I think, going forward. So we're located downtown Minneapolis. CBiz is a big company. It's a billion-dollar company, but our client base is really made up of small, closely held businesses, really very similar to what MPMA's client base is, so to speak. I would say that 90% of our clients have revenues between 1 and 25 million. We obviously have some very large clients and we have some smaller clients. While we do nonprofit, most of our work in Minneapolis is in the for-profit area. Most of our clients are first or second generation owners. And I would say most of our clients have anywhere from 1 to 10 owners. So I think our client base looks very close to the MPMA client base in that regard. We're going to be talking about business valuation today and different aspects of it. I am going to introduce Chris, and he will, we're going to stay pretty close to the slides, as you'll see today. It's a small group. It's an intimate group. Chris and I have done this seminar before, but usually we're sitting we're standing in the front of a room behind a podium, and there are people in front of us, so we don't have that luxury with COVID. But you do have the ability to wave your hand electronically and interrupt us at any point in time, and absolutely feel free to do that. We're going to leave time at the end for questions. We're going to speak for about 45 minutes, and then we'll have 10-15 minutes at the end for questions. But if you have questions throughout our talk, just electronically interrupt us, and we will address your questions. So I'm gonna pass the baton to Chris, and he's going to talk about what our objectives are today. Go ahead, Chris.
Great, thanks a lot. And like you said, feel free to ask questions. So we do our evaluations. We break them down to different groups, different steps. We're going to talk about those different steps. We're also going to walk through a couple of the methods on how we actually do the valuations. Then we'll discuss what we do with those values once we've calculated it. We discount or add a premium to them. And then we're also going to discuss a bit of what you can do to help the process and help the appraiser before you even get around to hiring them. So very first, we have to understand what is the premise of value. We have to understand, is this an ongoing business? And practically always, and especially in situations like we're probably talking about here today, it will be an ongoing business. It's a manufacturing company. We're not talking about a liquidation or anybody who's going out of business. That's a different engagement. Doesn't make sense to even talk about it in this scenario. So step one seems basic, but very, very important it's what are we valuing it? Who are we valuing it for? Why are we valuing it? And this is all important to establish up front. It helps us understand what are we doing and why are we doing it. We get to be more efficient, ask better questions, come up with a better product in the end. A lot of us would probably maybe be focusing on sale of a business here, or potentially gifting for moving a company to the next generation. Another part of the first step is, what is the premise of value here, or what standard of value are we using? Fair market value is usually our standard. Fair market value is willing buyer, willing seller, third party arm's length transactions. That's what we use for many buy-sell agreements, the sale of a business, gift, estate. We have different standards of value if it's a shareholder dispute. We have a different standard of value if, for instance, the sale of this business potentially is to a competitor. We use a investment or strategic value. This is an important difference because this is going to produce a higher value because they really are just buying the sales of your company. They potentially already have the overhead covered. They have an accounting department. They already have a president. They don't need to duplicate those. And these would be important differences, subtle differences that we would want to know when we're starting the engagement. So step two is gathering information. And there's three different parts that we go into the gathering of information. So there's the part that I do that essentially is probably back room in my office. I'm gathering the economic data for the current periods. I'm gathering industry info and possibly transactions for both public and private companies similar to this. Another part, this is more on the company, is I need the economic data. I need the financial data from tax returns, from financial statements. We're going to get, next slide. There we go. So I need to know information on personnel. We're also going to do an interview with the company to make sure that we do understand this specific company and where it fits in the industry. We need to understand what's the important things that are driving here. Where is this company headed? Step 3 is me analyzing all of this information that we've gotten. So we're going to take all this and mash it together. We're going to look at how is this fitting together? What are the ratios? What are the trends? Where are the projections for this company? What are they looking like compared to other companies in this industry? How does this industry compare to the general economy? This slide, next slide, is probably the most important thing that we're going to talk about today is normalizing the income. This is where I need to work with the company, the owners. I need to understand, what do we have to do to your income to get it to a normal amount? So one of the big items that we always have to discuss with a small company is owner's salaries, because these are small companies. You can pay yourself whatever you want. Some companies pay way too much, some pay way too little. And so we could be looking at two companies that maybe top line look very similar, sales, revenue, size, but bottom line, one company maybe makes zero and one company maybe makes, a few $100,000. And we're like, oh, there's a big difference here. I wonder what that is. It could be all wound up in owner's salaries. Maybe one owner is essentially taking out all of the profit because they can, leaving zero profit. Another owner has taken a very, very small profit or a small salary. The two companies look very different. When I normalize them, I find out what are their responsibilities of being done by the individuals and figure out what is a fair market salary for that. The two companies may end up looking very similar. Other normalizing items are personal kind of discretionary items that maybe a company doesn't have to do, but small companies choose to do. They run it through the tax return, they get the deductions. Cell phones, card, personal-ish, travel, you go to a conference, you bring a spouse, you add other items to it, you stay a little longer. These all end up on a company's deductions, but potentially a suitor or a buyer wouldn't necessarily need to incur these expenses. We're going to add these back. These are going to add profitability. Also, any kind of one-time expenses, if there's a couple $100,000 that you spent a couple years ago to move, okay, that's a non-recurring thing. You're not going to move every year. We're going to add these back. You may have some legal expenses. You may have insurance claim that comes in. These are non-recurring items. We're going to want to make these normalizing adjustments to get down to what does this company going to look like every year going forward. So then we take this information that we've analyzed and we go through 3 different approaches. We consider the 3 approaches in probably every case we do, every valuation. And the 3 approaches are market approach, cost approach, and income approach. And then now we're going to start walking through some of these, and back to Howard.
All right, thanks, Chris. So once again, just to summarize where we're at, we first have defined the assignment. The business owner calls us, the attorney calls us, and we've defined the assignment. We gather information. Chris talked about the information that we gather. In the old days, we used to get banker boxes. We used to get, 1, 2, 3 banker boxes, and it would take up our offices. Under COVID, and actually before COVID, everything is turned into electronic transfer now. So the good news is that my office is clean because I have no more banker boxes. The bad news is my emails are a disaster because I have a lot of electronic data in them. And then the third step is analyzing the information. So define the engagement, gather information, analyze it, and now we're valuing the company. So now we're going to talk about the 3 methods that are used in valuing a company. And the 3 methods that Chris just alluded to in the previous slide was a market method, the second was a cost method, and the third is an income method. I'm going to talk about the market method. Chris will talk about the cost and the income method, and then we'll put it all together. This slide talks about the market method, so I'm just going to do a very quick overview, and then I'll get into more detail. On the market method, we're comparing your company to either public data on the industry, public companies or private companies where there has been a sale transaction. And we're comparing the actual transactions, either public or private. We're looking at multiples, could be a multiple of revenue, could be a multiple of net income, and then compare those multiples against your company. Next slide, please. On the asset approach, which Chris will talk about, we're really looking at what's the bottom line, what's the hard assets of the company. This approach really isn't very useful for a service company like an accounting firm. If you looked at my assets, I have a table, desk, and chairs, and a computer. It's more beneficial for an asset-based company like a manufacturer or a real estate holding company. Then we'll look at the underlying assets, and Chris will talk about that. And next slide. And then the income approach. What we're looking at there is we're looking at the income of the company, and we have to define income. Chris will talk about how we define income. And then we're looking at rates of return to attract money to that cash flow. And so the income approach is all about measuring the income or cash flow of your company, and then what rate of return, what risk is incorporated in that cash flow to attract money to invest in your company. Next slide. So I'm going to talk about the market approach. And then again, Chris will talk about the other two methods. The market approach, we look at three different methods. We look at a guideline public company method. We look at a merger and acquisition method, and we look at actual transactions, buy-sell agreements and offers. So thank you. So the guideline public company method is where we're really looking at publicly traded companies and comparing those attributes to your company. The merger acquisition method is where we're looking at private transactions. And I would say that in Chris and I, in our world of valuations, a very small percentage of our companies do we really find publicly traded comparables. Most of our market approach methodology is looking at private transactions. So our steps, number one is we have to find guideline companies. How do we do that? Well, we can go in the public market, we can go on the internet. We can also look at our database. CBIZ has a tremendously large database of transactions that we have either from our existing clients or we have a database where it has obviously other transactions that we subscribe to. So we first look for guideline companies. We calculate multiples. Could be a multiple of revenue, multiple of bottom line. Could be a half a dozen multiples that we look at. And then we narrow down those half a dozen to maybe 2, 3, or 4 multiples that we think are most appropriate for your company. We apply the multiples to your company, and we might have 2 or 3 that we use, and then we reconcile the difference. And then if necessary, we apply discounts and premiums. So I want to go through an example of the market approach. This one's really, really simple, but I think it just demonstrates how we go about it. And in this case, we're using a public company. And so company A, company B are public companies, and then the subject company is your company. So we would list out different attributes. Could be revenues, could be book value, could be net income. And then at the bottom of the screen, we look at, in this case, because they're public, we look at the price of the stock, the shares outstanding, and then what's the market value of the company. So what we're trying to do is solve for the market value of your company by looking at the public. Next slide, please. So on the top half of this slide is identical to the previous slide. The bottom 3 lines are where we're coming up with market multiples. So for example, for company A, we know the value of company A is 120, could be 120 million or 1.2 billion, whatever the number is, it's 120. And we know the revenues are 400. So we just divide revenues into market value to come up with a multiple of 0.3. We did in this example, we did the same thing for book value, and we did the same thing for net income. Company B, we do the same transaction. And then off to the lower right, you can see we took a straight average. We just took 2 companies and we took a simple average. First of all, we would probably never use 2 companies in our statistics. 2 companies doesn't give us a comfort that those 2 represent the entire industry. But again, this is just for an illustration. So what our last step is taking those 3 multiples and applying it to our subject company. So next slide, please. So the average of the two publicly traded companies was, the average price was 0.33 times revenue. So we apply that to our company. Book value was 0.125, and then net income was 1.9. And so as you can see, we apply that to our subject company and we come up with a range of value. In this case, the range of value was anywhere from 66 to 77. And the point is that from using this method, we can narrow our range or narrow our value of your subject company. Let's go to the next slide. There's a lot of numbers on this slide, but what this is this is taken from our database. And I had Chris research an air compressor manufacturer. I just pulled it out of the air. And at the very top, you can see that there are, on the very top line, it says there are 58 transactions. And for the range, I asked them to go back 10 years. So these are actual sales of air compressor manufacturers that took place in the last 10 years, and there's 58 transactions. And then just reading across the top line, it breaks the values down between the bottom 10th percentile and then the top 75th percentile. And then we like to use the median because that represents what I'll say is sort of the midpoint or the average of these transactions. The most common multiples that we use are highlighted in yellow. And you can see it toward the bottom of the screen. We like to look at a multiple of sales, excuse me, a multiple of gross profit. And for manufacturing, we for sure like to look at a multiple of earnings before interest and taxes, which is EBIT, and earnings before interest, taxes, and depreciation. Because your industry is so depreciation heavy, we like to compare it to other companies, and we like to add back depreciation because there are so many different ways that companies can depreciate their equipment. You know, accelerated ways for tax purposes or straight line ways for book purposes. So we like to add back depreciation to get the true earnings of your company. But what this tells you is this gives you a really good indication of anywhere from 41 to 58 companies in their over the last 10 years who had actual sales, and you can see actual multiples and apply that to your company. Next slide, please. So we like to use the market approach in most of our evaluations. We like to use our database. Again, it's unusual to get public companies that are similar, but it's usually pretty simple to find companies similar to your company with our database. Other ways that we like to find public or private data is talking to the clients, you know, their trade journals or their trade associations. You know, by calling their trade associations, oftentimes there's studies that the trade associations incur that indicate valuation. And so a great source of data, trade associations. It's relatively easy to get the data. There's usually lots of information in the public market and the internet. If we're valuing a minority interest, it gives us that value, at least the public market does. And we'll talk about minority value later. Now, the one weakness is sometimes it's difficult to find similar companies. So it doesn't have to be exact. I don't have to find necessarily a manufacturer of air compressors. I might be able to find other companies that manufacture products that are similar or have similar components in which we can look at those transactions. So it's an approach that I would say 90% of our reports have a market approach consideration. And it's an approach that I would certainly consider if you or someone representing you were to call me. I'm going to toss it back to Chris, and he's going to talk about the other two approaches, the cost approach and then the income approach.
All right, so now the cost approach. Cost approach is really assets minus liabilities equal value. So you could really just think about your balance sheet. We do make adjustments to this. We adjust different assets to make sure that they are recorded at fair market value. Your balance sheets aren't necessarily recorded at fair market value. A couple examples would be like machinery and equipment is on your books at a depreciated value. We would want to at least consider adjusting them to fair market value. Another example would be if your company has land and building on the books, that would want to get adjusted to fair market value. Accounts receivable, we want to make sure are recorded and are recorded at a collectible rate. So either A, if there aren't accounts receivable, we want them added, or make sure that the amount that's recorded is collectible. Make sure that there are any, if there's any off-balance sheet liabilities, we get those recorded, or potentially any tax liabilities, especially related to the adjustments that we make. We will not usually rely on the cost approach or asset approach for an operating company. Biggest reason, you can see the bullet point at the bottom here, it does not capture the goodwill or blue sky value of an operating company. So that's a big weakness, but next slide does show when we would potentially consider this. So it is helpful for holding companies or real estate entities. So maybe your company has a land and building in an LLC that's held separately. We would absolutely rely on the cost or asset approach in that case. There are times that we do rely on it, but mostly for an operating company, we calculate it, we consider it, we don't rely on it. So income approach is the next, there we go. Next big item, this one is the bread and butter of probably just about every valuation we do. What we're doing here is we are calculating income, or therefore cash flow. Cash is king. The bottom line to a value is how much cash can a company produce and provide to its owners. That really is the essence of what value is. So we almost always rely on one way of income approach, one method or another. We're going to focus on two different methods here. There's basically a single period, and we're going to walk through an example here of how we kind of go through and calculate that. And then we'll also talk about how we can look at a multi-period or a multiple period discounted cash flow. So there you go. In its essence, single period approach is actually very simple. We calculate income or cash flow and divide it by a capitalization rate. Very simple to understand, very easy calculation. However, there's a lot of nuances that go into this. One of the biggest problems is figuring out what is that normalized income or cash flow. And then the second part is figuring out, deciding what is the correct capitalization rate. So formula, very simple. The application is I guess, what we spend our time doing and what makes it hard. We also have to take into account growth, those kinds of items. So like I said, the first item is we got to figure out the income, or in this case, cash flow. So we start with net income after taxes, and notice here, of course, this is normalized. So we'd already talked about a number of normalization adjustments that we would make. So we would start with your financial statements, but then normalize them. We're going to figure out the fair market value of the officer compensation. We'd make any of those one-time adjustments. We would add back any of the personal discretionary expenses that a buyer wouldn't necessarily go with. So we start with normalized number. We add back non-cash items like depreciation. So it's a big expense, but yet it's not costing you cash. And then now we flip the other way. We look at other items that aren't income or expense items, but capital expenditures, working capital, and debt payments. In this case, we started at $900,000. We've got pluses. We discuss minuses, end up at cash flow here in this example, $1.1 million. All right, now what do we do with that? So here we're going to walk through, we take our $1.1 million cash flow, and then we've got a discount rate. So in this case, we've decided 22%. Now, discount rate, you can kind of think of as the risk, or what does it take for an investor to put their money into this investment. Investors are smart. There's a whole market and world of other investments out there. So if you think treasuries essentially are risk-free, but they have a very, very low rate of return. You know, we're talking somewhere 2 to 5%. If they want more return than that and are willing to accept some risk, we move to the stock market in general. So the publicly traded big companies. There you're going to be talking more in the 10% range. So you're accepting some risk, but you're getting better return. Next step down are private companies, which is more like what we're talking about here, more risky than a Fortune 500 company. So you get more return on your money. We always find somewhere in the 15 to 25% range. And in this case, we would do our study, calculate a build-up approach, and we've decided 22% is appropriate. In addition, we've also considered the industry in this company and decided 5% growth. So we're going to say this is going to grow 5% every year. So now we're back to the simple formula. We've done the hard work. We've got the cash flow of $1.1 million, our discount rate 22%, growth of 5%. Now you just do math. The value that we've calculated here, $6,470,000. So like I said, simple calculation, a lot of work goes into it.
So Chris, before you go into the next one, I just want to point out a couple things. So we're all going through COVID. And so Chris and I are valuing companies, and the sales in 17, 18, and 19 were, 9.8, 9.9, 10 million. And then in 2020, the sales dropped to 8.5 million because of COVID, because they were shut down for whatever reason. They couldn't get supplies. Their customer base was shut down. And so the revenues were down, bottom line is down. When Chris and I are looking at companies in the COVID world, again, we're looking at what's normal, what's the normalized net income for this company. So when we do a single period calculation that Chris just went through, in the COVID world, it's difficult because we have revenues and we have net income that have dropped in the last 12 to 18 months. Because of that, we now look at a multiple year period valuation, which Chris is about to go into, because now we might say the company sales were 10, now they're 8.5, but it's going to take 2 years to get back up to 10 and then a 5% growth thereafter. Well, the single period method mathematically we can't use that method in the COVID world when there's been such a large decrease. So now Chris is going to talk about a multiple period method where we can take into effect perhaps the reduction in the company's sales bottom line and then a growth to get it back up to normalization. So go ahead, Chris. I'm sorry.
Well, now you just ruined the biggest surprise of the whole presentation. So just discussed the single period, which works great within a non-COVID world and for a mature company that's established and not changing. We live in a changing world, as previously noted, or companies could be in a growth mode that they're going to have growth really big for a couple years and then taper off. New product coming in that's going to change something, or the economy may be changing. That just saying one income stream for the rest of perpetuity isn't appropriate. So what we could do then is discuss a multi-period. We essentially do the same calculation that we just did. We just do separate single multi-periods going forward. And then essentially we add them up and discount it back to today's value. So it's the same idea as the single period. We just do it multiple times going forward and then discount it back to today's value. Discounted cash flow, you've maybe heard those terms. So strengths and weaknesses. Strength, this is, it's our bread and butter. It's our close to pure valuation theory. We are calculating cash being provided, and that is the source of, the value. Downsides, difficult to project. There are, you know, a lot of multiples we need to understand and figure out what do we think growth is? What do we think the bottom line is going to be? What do we think are there going to be any changes? So a lot of variables, a lot of assumptions to be made. And then also the other side of that is we also have to figure out what the discount and capitalization rate is, which can be difficult and requires, again, a lot of assumptions on our part. So now we've had 3 different ways of calculating value. I'm going to pitch it back to Howard. And we're going to discuss what do we do with these values.
All right, thanks, Chris. So that's right. So now we've gathered the information, we've analyzed it, we've done 3 different valuation methods. We've done a market approach, could be several market approaches. We've done 2 or 3 different income approaches. We've looked at a cost approach, and we've got a conclusion anywhere from, let's say the 3 approaches are anywhere from 10 million to 11 million. So we'll come up with a reasonable number that we feel is our conclusion. And then the next step is considering premiums and or discounts for our conclusion. And again, this goes to who's the reader of our report. If we're selling 100% ownership interest in a company, we're not going to discount. If we're gifting to the next generation, or if it's part of an estate, person passes away and has ownership interest in a closely held company, we are definitely going to consider discounts. Buy-sell agreements. Half the buy-sell agreements I read have discounts, half of them don't. Depends what your buy-sell agreement reads. Litigation. Depends which side of the table you are when you're litigating, but discounts, you know, are generally considered for family court. The discounts are considered for shareholder partner disputes. Discounts may be considered. There's case law going both directions on shareholder partner disputes. So what are the discounts that are most often? There's 2 discounts that are most often considered. One's called the lack of control discount, which is the screen we're looking at. And in a few screens, we're going to have one that's called lack of marketability. So let's talk about lack of control first. So what are the advantages of control? Well, they're fairly obvious and they're on the screen. A controlling ownership interest, and a controlling ownership interest is generally 50 point something percent, right? Anything over 50% is control in a small, closely held company. I mean, if I had 5% of 3M, I'd actually have control of 3M, but in a small, closely held company, control is generally a little over 50%. So what are the advantages of having control? Well, obviously you can elect directors, you can appoint management, you can determine compensation, very important. You can set policy, you can acquire and or liquidate assets. You can select who you want to do work with, who you want to have your contracts with. Next slide, make acquisitions. You can liquidate, obviously dissolve or recapitalize the company. You can pay dividends. Very important for a closely held company is how do you get money out if you're an owner? Well, either salary or dividends. Dividends are usually, you know, distributions for an S corp. So those are the next slide, please. Those are the advantages of control. So the marketplace tells us that if you don't have control, if you have lack of control, that discounts should be considered. Big picture is if I've got a company that's worth $10 million and I have somebody that owns 50% and I have 5 people that own 10% each, those 10% ownership interests, well, 10% of 10 million is $1 million, but they're not worth $1 million. You probably could not go in the market and sell a 10% interest for, you know, pro rata for 10% or in my example, $1 million. Discounts are going to be considered by the buyer. The courts had considered discounts. Gift and estate tax code considers discounts. At least it does today. I know that the current administration is looking at removing those discounts. And so we'll talk about that in a minute. But right now, minority and lack of control discounts are and should be considered in certain situations. The discounts range anywhere from 20 to 40%. And there's studies that Chris and I use to help determine what discount we should use in that large range for lack of control. Let's go to the next slide, please. And then the other discount is lack of marketability. I own $1 million of a closely held company and I own $1 million of 3M stock. They're both worth $1 million. 3M stock I can convert to cash in 3 days. My $1 million of my closely held company, I can't convert to cash that quick. to sell a company could take anywhere from 3 months to, a year or more. And there's lots of costs associated with selling that company. Whereas selling, publicly traded 3M stock, there's really no costs, or it's de minimis. So there are discounts that ought to be considered for lack of marketability. Again, there's various studies that Chris and I look at, and we'll compare those studies against your company. Generally, the range of discounts is in the 20 to 40% range for lack of marketability. And we will consider that for minority interests. We'll consider it on litigation, and certainly gift in the state. Next slide, please.
And then, can I stop you just for a quick second? So Kyle Brem has a comment.
Okay.
So I wanted to just make sure that I get that in there real quick. First, super interesting stuff thus far. Another issue I commonly see overlooked or not fully vetted during the valuation phase or prior to is potential tax liabilities, historical and prospective. This clearly impacts FCF, which can dramatically change valuation.
So when you say potential tax liabilities, are you talking about tax on the sale of the transaction, or are you talking about how the business owner is, perhaps they buy $1 million piece of equipment and they write it off immediately because the tax code allows them to do that?
I'm going to allow him to talk.
Yeah, absolutely.
Kyle, you can speak if you'd like. No, looks like he's not going to. Okay.
Okay. Well, the other thing, Kyle, is again, you're going to see at the end of this, you'll have my contact and Chris's contact, so we can talk more intimate on a specific question. But if it's the tax on the sale of the business, I'm hired to value the company. There's different ways to structure a sale to reduce the taxes. That's a different issue. That's a different seminar, so to speak. But I certainly have a strong background to help you on that. But what Chris and I do, because of, particularly in the manufacturing world, where you can take a piece of equipment for $1 million, you can depreciate it over 10 years, or you can write it off in one day, basically, with the new tax code. That could have an impact on value. So we have to analyze those type of transactions. Same thing with receivables and inventory, how they're priced out. Inventory can be priced out in such a way that could be reduce your income for tax purposes or increase your income depending on how you handle the inventory. Same thing with allowances on receivables. So those are things that we have to consider when we're valuing the company. But if you're talking about the tax on the sale, that's a different transaction, different discussion. Let me go through the last discount because I want to make sure we're sensitive to time. So the last discount that we may consider is a key person discount. Probably not going to happen on a manufacturer, more of a service organization. Key person discount is where the loss of that key person is going to have a financial impact on the company, and something that we'll consider. Tax code cases or tax cases show key person discounts anywhere from 10 to 45%. You don't see it very often on closely held companies unless it's in the service business. Next slide, please. Then the last thing that we do, obviously, is after we've done all this work, we sit back and we just test it. Does it make sense? If we're putting together a valuation for a buy-sell agreement, does it make sense to the reader? If it's for litigation, does it make sense to the trier of fact, the judge? If it's for court, does it make sense to the reader, who it's going to be the IRS? If it's for gift or estate, the state of Minnesota or the IRS. And if it's for litigation or for a divorce, does it make sense to a trier of fact? So that's our last step, is testing the reasonableness. And then the last thing that we want to talk about before we do, I'll quickly talk about fees at the end, is what you as a business owner can do prior to hiring the appraiser. And I'm going to let Chris talk on that topic.
Well, great. Thank you. Sarah, if you wanted to slowly scroll through the next few slides, there's a lot of things to read. I'm not going to read them all myself, but the things that you can do before you hire an appraiser, start pulling together the information. So start getting your financial statements together, tax returns, create a good company description, include important key employees, make sure that you have good, accurate, updated budgets or projections, sales projections. And then I'm going to focus again on those normalizing adjustments that I had talked about. These are areas that we're going to use to help bolster our value and potentially create value here for you. So think of those normalizing adjustments, things that are running through that may be discretionary, one time. Start working on some of those items. And then just a plug for appraisers here, make sure you pick somebody who has experience, that has some designations or certifications behind their name. There's several. Pick somebody that has designations and experience, and make sure that they've done the work before. And then, as Howard said, we're going to tell you low fees.
All right, well, so the last thing is what does it cost to do a valuation? Well, there's 3 different reports we do. If I'm having lunch with a client and they say, what's my business worth? I just want a back of the napkin. That's going to be what's called a calculation report. Fees are going to be, as you can see, $45,000 to $5,000. You're going to get maybe not all the methods, but 1 or 2 methods. You'll get a cover letter, and it'll give you an indication of value. The next level up, which is the one we do most often, is maybe it's going to be for a buy-sell agreement. Maybe it's going to be for a reader who knows the company, knows the industry. So we're not going to talk a lot about the company or the industry or the economic environment. We're going to spend more time talking about the methods and how we arrived at our key assumptions for those methods. That's in the $500 to $7,500. And then the top report is a comprehensive report. That's a report that we'll use for litigation. We'll use it for IRS, gift and estate. We'll use it for a reader who doesn't know the company. So it's a 100-page report. It explains the company, the industry, the methodology, and then our conclusion. Whereas the other reports don't go into the same level of detail of the company, the industry, the economic environment. It sort of gets to the conclusion. So when I have my lunch with my client, they don't need to know all that information. They just want to know, what's my company worth? And that's what we do when we do a calculation report. So with that last part, here's our contact information. Both Chris and I seem to be available 24/7 these days, so you can get a hold of us, phone or email. And if you have any specific questions about your company or your process, we'd be more than happy to help.
Absolutely.
Thanks, guys. I have a couple of questions. So, if you could you define the timing and on the valuation process?
Sure. Chris, do you want to take that?
Sure. Yep. Yeah, I'll handle that one. So part of our process, we send out a comprehensive list of all of the items that we need from the client to do, much like the last several slides that I had gone through there. Once we receive all that information, we'll do an interview, and kind of start to finish, once we have all the information, you could expect about a 2-week turnaround.
All right. Another question we have is, how do you position the company for sale?
By the way, the 2-week turnaround assumes that Chris and I do not take a vacation, just so you know.
Working 24 hours a day.
We each get 2 days off a year. So how do you position your company for sale? Well, first of all, slides 40 through 43 that Chris just went through give you a pretty good idea of what I'll say is organizing your back room. So if you're putting your company up for sale, you can assume the buyer is going to do their due diligence. And the due diligence, it can be a 1-page document, it can be a 10, 15-page document. But the buyer is going to want to look at historical tax returns, historical financial statements. They're going to want a list of all your equipment, when you bought it, what you paid for it, maybe the attributes of the equipment, particularly a manufacturing company. Some of that can come off your depreciation schedules that your outside CPA prepares for you, but some of it you may have to beef it up a little bit. They're going to want a list of your employees, date of hire, their salary, positions in the firm. Buyers are going to look at important contracts with vendors and with suppliers, key customers. Again, all that should be available, not to interview key customers, but should be available for the buyer to look at for their due diligence. Their buyer is probably going to look at budgets that you prepare, forecasts. And what I always tell clients that are looking to sell is at least 1 and hopefully 2 years before you put your company up for sale, you do what we call cleaning up the income statement. So if you've got your spouse's car on the books, now's the time to clean it up. if you've got cell phones, if your kids are getting paid and they're not really working very hard, get in. I'm not saying any of our clients do this, but it's been known, get them off your payroll. Remove, if you have personal charitable contributions, you run through the firm, take that off the firm. If you go on trips, if you go on conferences and then you mix a vacation in with that, that's fine. But the last couple of years before you sell, get that off your books. The math is very simple. If you run $20,000 of personal expenses through your business, and many clients do, and sometimes it's more, sometimes it's less. But if you run $20,000 of expenses through your business, you're going to save $10,000 in taxes. Good for you. But that if you're looking at a 5 times multiple, that's going to cost you $100,000 in business valuation, right? 20,000 times 5. So you need to be proactive. You need to think about your income statement for at least 1, and I would think 2 years prior to the sale, so that the buyer gets what I'll call a very clean picture of the operations of your business.
Great, thank you so much. One more, we'll just quickly finish up with this one. Who should be on your team when you're selling this business? Nothing's back, who's going to back you?
Yeah, well, that's a good question. So your team should include your business attorney, and just make sure that he or she has M&A, merger acquisition experience. If your attorney is with a larger firm, then there's going to be an M&A person in that firm that can help out. If you're working with an attorney who does it all, so to speak, just make sure that they have that M&A experience, because an M&A transaction is different than other transactions, and you want to make sure that they're not learning on your transaction. There could be certain tax attributes or the wording of the letter of intent if you're buying, or the wording of the purchase agreement if you're selling, and you just want to make sure that all the dots are covered. Other people on your team, obviously besides the attorney, is your company's CPA. You'll want a business broker. Most people are using business brokers. You'll want to bring in a valuation expert, I would think. Valuation expert usually is at the very front of the analysis. Now, if a buyer comes in and starts negotiating, excuse me, the valuation expert may be able to help with the negotiations in terms of why they believe the value is higher than what the buyer. Remember, buyers are looking to buy it less, and sellers are looking to obviously sell it at a higher price. You may include key employees. That's up to you. VP of sales, head of the accounting department, head of the manufacturing group. Usually you bring in your key employees, not at the beginning, but more at the middle or at the end, because you want to keep it quiet until it's at a certain point.
Yeah.
It's not uncommon for the business broker to help assemble your team. And so I would think that in terms of timing, you bring in the valuation, group first. You bring in your business broker, your CPA, and your attorney sort of second, and then you bring in, the head of the different divisions, whether it's sales or manufacturing or accounting, bring them in third in terms of timing. And that difference could be anywhere from 30 days to 6 months. A transaction for a large manufacturer, it doesn't happen overnight. Yes, sometimes it happens in 30, 60 days, but my experience is that these transactions can take anywhere, upwards of a year or more, in, finding the right candidate and then negotiating a price. And then after you negotiate a price, the attorneys get involved, and, that can take a month or two to make sure that all the wording is correct for both parties.
Absolutely.
The last step is just the tax aspect of it. There's so many ways to structure a sale that are beneficial tax-wise to the seller, that are different beneficial tax-wise to the buyer. So that's part of the negotiation process, and that's why you'll want to bring in your CPA to help.
Absolutely. We do have another question from Lori. How do you apply value to the intangible assets of a company?
Well, so Chris talked about it and I talked about it. If the book value of the company is $1 million, and through an income approach or through a market approach, we say the company is worth $10 million, the hard assets are receivables, inventory, equipment, less payables and debt. So the hard assets are worth $1 million in my example. We said, when you hired us, we said the company's worth 10 million. So the intangible value is the difference, or $9 million. So when you hire an appraiser, our job is really to come up with the overall value, in our example, 10 million, to look at the hard assets, less debt, and that's $1 million in my example. So that difference of 9 million is intangible.
It's encompassed in the cash flow that we are using to value.
Correct.
Wonderful. Well, thank you guys so much for this presentation. Just a reminder to everybody that, this is being recorded. Save the date. We talked about this already at the beginning, but the next CBIZ session is June 22nd. Those that signed up for today and for the first session will also get a reminder of this. So please make sure that you're signing up for each session. And then other reminder is, we have our summer social on June 17th, and that'll be at the Lookout Bar and Grill in Maple Grove, and golf registration is open. So come on out, guys. We're ready to see everybody in person. Thank you again, everybody, and have a great day.
And Lacey, will they get a copy of the slide presentation that has
Absolutely. Everybody gets a copy of that as well.
Good. Thank you, everybody.
Thank you. Everybody have a great day.